Well, talk about ending the week with a bang. General Electric is continuing its makeover, and in this case, it's an extreme makeover. Last night, we told you the widely held Dow Component was close to a deal to sell its real estate portfolio. What we didn't know was that that was just the beginning. The company is planning to essentially shed its entire finance unit. The first move is a $26.5 billion sale of most of its real estate and mortgage portfolio to Blackstone and Wells Fargo. But GE is not stopping there. The company will dramatically slim down GE Capital over the next few years and buy back $50 billion worth of stock. That buyback ties Apple for the biggest single buyback ever. Now, Wall Street loved the moves and sent shares higher by about 11% on the day. Mary Thompson has our look at the deal and the new GE.
In his most aggressive move in 14 years as CEO, Jeff Immelt plans to slash the size of GE's finance unit, a business once a strength for GE, now seen as a drag.
And we kind of felt from an investor standpoint that this was the right time.
The right time because low rates mean yield-hungry buyers will pay up for these assets. And selling them means GE may be cleared to come out from under a stricter regulatory regime mandated for firms deemed systemically important. The news sent the stock to a 52-week high, earning praise from investors.
I think GE is doing the exact right thing.
Now you can understand the company.
For Immelt, the restructuring puts GE on the path to be a pure industrial play, a company providing tools to build out infrastructure around the globe, and one that won't be penalized for its financial business.
At the end of the day, being able to re-rate the company as a premium industrial company with a very small financial service business that really complements the industrial assets, I think is the highest, is really a value-creating move.
Value Immelt struggled to generate as the stock's off 30% since he took the helm.
I definitely think he heard the critics and he's answering them.
By 2018, 90% of GE's profits will come from its core industrial businesses, including power and water, aviation, healthcare, oil and gas, and transportation. That's up from just over 50% last year. Profits from finance will drop to 10% from 42% in 2014 as GE looks to unload $165 billion in assets, including U.S. and international banks and global commercial and consumer lending businesses, all over the next 2 years. GE will hold on to businesses that finance client purchases of its jet engines, energy, and healthcare equipment. Even as it undertakes this massive restructuring, GE still expects to meet profit forecasts for 2018 and will make up for lost earnings at GE Capital by growing profits at its industrial businesses and with a record $50 billion stock buyback program that will significantly shrink its shares outstanding. All moves designed to keep investors engaged as the 123-year-old company starts yet another new chapter. For Nightly Business Report, I'm Mary Thompson.